jumping on the bandwagon without fully understanding what you are buying. Buffett warns that blindly following the herd in an overvalued market is a sure way to lose big. In this video, Warren Buffett shares his insights on the 7 mistakes investors make, especially during overvalued market. Here's how to spot the red flags before it's too late. Mistake number 1. Ignoring valuation metrics. One of the most common mistakes investors make is overlooking key valuation metrics, particularly the price-to-earnings ratio. The price-to-earnings ratio is significant because it helps assess whether a stock is overvalued or undervalued relative to its earnings. A high price-to-earnings ratio may indicate that a stock is overpriced, while a low price-to-earnings could suggest it's a bargain. Let's consider the story of an enthusiastic investor named Sarah. Eager to jump onto the latest tech trend, she invested heavily in a popular startup without checking its price-to-earnings ratio. The excitement around the company masked its inflated valuation. Within months, the stock plummeted as reality set in, and Sarah lost a significant portion of her investment. This experience serves as a cautionary tale. It highlights the importance of considering valuation metrics before making investment decisions. By understanding and analyzing price-to-earnings ratios, you can better gauge a stock's true value and avoid costly mistakes. If you're enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Mistake number 2. Fear of missing out. The fear of missing out, or FOMO, is a powerful psychological force that can lead investors to make impulsive decisions, often resulting in the purchase of overvalued stocks. When everyone around you is raving about a hot stock, it's easy to feel pressured to jump in, even if the fundamentals don't support the price. This emotional response can cloud judgment and lead to significant financial losses. A prime example of FOMO in action is the tech stock bubble of the late 1990s. Investors flocked to companies like Pets.com and Webvan, driven by the excitement of the internet boom. Many bought shares at inflated prices, ignoring the lack of sustainable business models. When the bubble burst, countless investors were left holding worthless stocks, having succumbed to the allure of quick profits. To avoid falling into the FOMO trap, it's essential to stick to your investment strategies and conduct thorough research. Remember, market hype can be misleading, and it's crucial to focus on long-term goals rather than short-term trends. Mistake number 3. Following the herd. Herd mentality in investing can be a dangerous trap that leads to poor decision-making. When investors follow the crowd, they often succumb to groupthink, ignoring their own research and instincts. This collective behavior can create bubbles where stocks are driven to unsustainable heights only to crash when reality sets in. A notable example of this is the 2008 financial crisis, was fueled by herd behavior in the housing market. Many investors and homeowners jumped on the bandwagon, believing that real estate prices would continue to rise indefinitely. As more people bought into the frenzy, they overlooked warning signs and the underlying risks. When the bubble burst, it resulted in devastating losses for countless individuals and institutions. To avoid the pitfalls of following the herd, it's crucial to engage in independent research and critical thinking. Take the time to analyze the fundamentals of any investment and consider whether it aligns with your financial goals. By cultivating a mindset that values informed decision-making over popular opinion, you can navigate the market more effectively and make choices that are right for you. Mistake number 4. Timing the market. Trying to time the market, predicting when to buy low and sell high, can be one of the most challenging and often unsuccessful strategies for investors. Many believe they can outsmart the market by identifying peaks and troughs. But the reality is that even seasoned professionals struggle with this. Market fluctuations are influenced by countless unpredictable factors, making it nearly impossible to consistently time your trades accurately. Consider the story of an investor named John, who became convinced that the stock market was at its peak. He sold off his investments, waiting for a downtrend to buy back in at a lower price. However, the market continued to rise for several months, and John missed out on significant gains. By the time he decided to re-enter, he found himself buying at much higher prices, ultimately leading to frustration and regret. By focusing on the fundamentals and holding investments through market fluctuations, you can benefit from compounding returns and reduce the stress of trying to predict short-term movements. Remember, investing is a marathon, not a sprint, and patience often pays off in the long run. Mistake number 5, overconfidence in predictions. Overconfidence in one's ability to predict market movements can lead to significant investment pitfalls. Many investors fall into the trap of believing they have a unique insight or a foolproof strategy, which can cloud their judgment and result in poor decision-making. Relying too heavily on personal predictions often leads to taking unnecessary risks, as investors may ignore critical data or dismiss contrary opinions. Take the story of an investor named Lisa, who had a strong track record of successful trades. After a few profitable investments, she became overly confident in her ability to predict the next big stock. Ignoring market trends and expert analyses, she invested heavily in a company she believed would skyrocket. Unfortunately, the company faced unexpected challenges, and Lisa suffered significant losses. Her overconfidence blinded her to the risks involved. To navigate the complexities of investing, it's essential to cultivate humility and embrace continuous learning. Acknowledging that no one can predict the market with certainty can help you remain open to new information and diverse perspectives. Mistake number 6, neglecting diversification. Neglecting diversification can significantly increase risk, especially in an overvalued market. When investors concentrate their holdings in a few stocks or sectors, they expose themselves to greater volatility and potential losses. If those specific investments decline in value, the entire portfolio can suffer dramatically, leaving investors vulnerable to market fluctuations. Consider the case of an investor named Tom, who was heavily invested in a single tech company that has seen rapid growth. Confident in its continued success, he neglected to diversify his portfolio. When the tech sector faced a downturn due to regulatory changes, Tom's investment plummeted, resulting in substantial losses. His lack of diversification meant that he had no buffer against the market's volatility, and he learned the hard way that putting all his eggs in one basket was a risky strategy. To build a balanced investment portfolio, it's essential to spread your investments across various asset classes, sectors, and geographic regions. This approach can help mitigate risk and enhance potential returns. Consider including stocks, bonds, and alternative investments to create a well-rounded portfolio. Mistake number 7, emotional decision-making. Emotional decision-making can significantly cloud judgment in investing, often leading to costly mistakes. Fear and greed are two powerful emotions that can drive investors to make impulsive choices. When the market is booming, greed can push individuals to chase after high-flying stocks without proper analysis. Conversely, during downturns, fear can lead to panic selling, causing investors to lock in losses instead of holding on for recovery. Take the story of an investor named Rachel, who experienced both extremes. During a market rally, she became overly excited and invested heavily in a trendy stock, ignoring its fundamentals. When the stock price eventually fell, fear took over and she sold at a loss, convinced that the market would continue to decline. Rachel's emotional responses led her to make hasty decisions that ultimately hurt her portfolio. If you want to know more about the path to prosperity, check out the video here and see you there.